Good afternoon. Thank you for joining us. My name is Brian Hartstein with Bayntree Wealth Advisors, and this is our second quarter financial and educational webinar for all participants in the 401k plans that we help service. So normally we pick a topic that we find of interest or that we received a variety of questions on throughout the year, and we try to do a little bit of financial education, provide the participants with some additional background in those areas, and hopefully just help broaden everybody's horizons in terms of those topics. So normally these will run anywhere from 20 to 30 minutes depending on the topic itself and questions and answer period. So anyway, we love providing these for you. We're here to help support you in terms of how you utilize your 401ks and just general financial education. So we love doing these. And again, if you ever have any questions about the 401k or about financial planning in general, always feel free to reach out to us, and I'll introduce our team in a few minutes here. But we are recording this webinar like we record all of our webinars. So if you are not able to stay for the whole thing, or you know somebody else that wanted to be on it but was unable to participate due to the time of the day, just let them know that it will be recorded. We will send that out to your HR people so they can post it to your website, and you should be able to listen to it, or they can listen to it at their own time and when it's convenient. So anyway, but again, we are here to help. Let me introduce the members of the team that certainly help support you in the 401k plan that you're in. Let's see if I can get over here to make the webinar work. There we go. So I'm Brian Hartstein again. I'm the one conducting the webinar, and I work directly with the trustees and the HR departments on your specific 401k. We have Chris Roger. Chris Roger is a financial advisor here at our office who also helps to work and support the 401k plan. And he is available if you have any questions whatsoever about the plan itself, how it operates, how you might utilize it, eligibility, and also any other financial planning related topics or questions as well. There's no cost for utilizing us as a resource or asking questions. That's what we do as part of our efforts to support the plan. So I urge you to take advantage of Chris and our staff here. We can be of any help whatsoever. That's what we're here for. And Rena Blanco and Megan Shai are also here, and they help work on the operations side of the plan. So chances are, if you're going to need some support or you want to talk to our office, you're going to be talking to one of the four of us. So we always like to let you know who's helping you and who you might be speaking to in terms of helping solve your problem or answer your questions. So anyway, if there are topics that you're interested in or you think you might want to hear about in the future in a more in-depth webinar, please let us know. Email us, call us, let us know what those are, because if we get enough questions about those topics or enough people asking about it, we'd love to tackle those later in the year or next year. So if you have topics, I urge you to let us know what they are. So anyway, why don't we just jump in, because today's topic I think is a good one that we get a lot of questions on, and it has to do with the use of mutual funds versus the use of a new tool, a relatively new tool called exchange-traded funds, or ETFs. So we do get questions on what is a mutual fund, what is an ETF, what do they do, why are they different? Looks like I might be able to use one or another or both, whether it's inside my 401k or with after-tax money. So we thought we'd tackle this as a topic because we really think it's a good one. So this is kind of an overview of what we're going to go through today. And before we get into any conversation about what a mutual fund is or what an exchange-traded fund is, we have to talk a little bit about diversification and what that is, because that has a direct correlation to what those investment vehicles can do. So we're going to talk about diversification first. Then we'll talk about what is a mutual fund, and then what is an ETF, an exchange-traded fund. And then we'll go through some of the similarities and differences between each of those. And then finally, we'll tackle when you might want to utilize one as opposed to the other, or both. So diversification, I assume most people are familiar with what diversification is, but I think it's a great point to start with in terms of this topic. And obviously, it's a way to reduce risk. So we're usually looking at utilizing a variety of different assets and investing in those as a way to reduce your risk. So obviously, if you held one stock, you could go up and down with the stock's price. But if you own more than one stock, it might be a way that you can reduce your risk in terms of how much gain or how much loss you might take over a current period of time. And many times when people are structuring their portfolios or building 401ks and looking at their investments, what they're trying to do, and it's something that we preach here strongly as well, is utilizing different assets and asset classes that will not react in the same way to market changes or not react in the same way to each other. Because the goal there is to reduce what we call volatility. And so that if asset A is up, asset B might not be up as much, but when asset A is down, asset B could be up. And therefore, it does what we call smoothing the ride. Normally, if we're going to look at a way to reduce risk, you normally want to look at probably between 15 and 20 stocks if we're going to look at individual stocks. And if we look at a mutual fund, that's normally going to hold anywhere from 80 to 100 plus stocks. So by using one specific mutual fund, you are having diversification within that asset class. An asset class might be large capitalization stocks or blue chip stocks. But you're usually going to hold 100 plus of those in a mutual fund, so you're going to be able to achieve some diversification that way. ETFs can hold a lot less stocks, maybe down in the 20s, but they also can hold upwards over 100 too. So ETFs also have diversification because they're going to be holding a basket of different stocks as well, depending upon the asset class that they want to invest in. So some factors to consider when we're putting together mutual funds and ETFs beyond just diversification is I always look at moving parts. So if the more you have more moving parts and the more moving parts there are, probably the more expensive it is to use that particular instrument. Or if you're comparing mutual funds or comparing ETFs, the ones that are more complicated, the ones that are more sophisticated in their strategy, and the ones that have more moving parts are most likely going to be more expensive. And what that means in terms of an expense, we'll talk about a little bit later on in terms of what an expense ratio is. And that's the charge that is levied by a mutual fund in terms of how it manages the assets each year. So that's your cost for being in it. So again, the more complex it is, the more moving parts it is, probably the more expensive it is. Then there's a little bit of philosophy that goes into this, and that's where we talk about what's called an active philosophy or a passive philosophy. We'll go into the definitions of both of those, why they're different, and which is better is really a matter of personal preference, but it's also going to depend on the market cycle that we're currently in. Active philosophy means you might have somebody that's picking stocks and making changes to those stocks or asset classes throughout the year. And where a passive strategy might be is we're just going to buy a basket of stocks, or we're going to try to mimic an index like the S&P 500, and we're just going to hold it, and we're not going to make any changes. So again, some people believe that one's better than the other. Some people believe that a combination of those strategies work well. But which will perform better is going to be dependent on the market cycle. So, for example, the last 5+ years, we've been in a market cycle where passive has outperformed active. Does that mean that's going to happen in the future? We don't know. Could continue. It could flip. There's been times in the market cycles where active management has been better than passive. So, again, a little bit of philosophical difference, but again, also will depend on what you believe and the market cycle that we're in. And then finally, with mutual funds and ETFs, there are some tax advantages and disadvantages to each one of those. Now, inside of 401k account, those are usually not a consideration because, again, a 401k is a tax-deferred plan, meaning if you have monies in your 401k account, you are not going to pay taxes while those monies grow inside the plan. So those tax advantages and disadvantages really wouldn't apply in a 401k or another qualified plan. But outside of 401k, if you hold an ETF, an individual account, those might be a consideration, and we'll talk a little bit about those. And a final note on diversification. So when we talk about risk and the risk you might take by investing in one particular thing over another, there's something what we call non-market risk. Non-market risk is also called undiversifiable risk. It's also called systematic risk. But basically, and most simply, it's risk that you cannot possibly eliminate through diversification or anything else. It basically says if you're going to own this, you have to accept this risk in any investment. So you can't eliminate this risk. And so if you look at the graph that I provided here, if you look at the left side, that shows what non-market risk is. You might have 100% non-market risk, you might have zero. And then the bottom part of it shows how you diversify by the number of different securities or stocks, let's say, that you own. So obviously, as we move to the right, the more stocks that we own, the more we can bring down non-market risk. So again, more diversification, more number of securities we own, the lesser amount of non-market risk that we have to assume. And that's what diversification does for us. It takes the risk that we can eliminate and helps reduce it. Now, we can never eliminate it, but we can reduce it through a variety of strategies. And that's really what the essence of diversification is. Okay, so let's take a look at a mutual fund. A mutual fund is a pool of money that's put together by many different investors that you do not know that all might have the same investment objective. And one of the reasons that they do this is think of economies of scale, like going to Costco. If I went to buy an egg at the supermarket and I just wanted one egg, I might have to pay $1 for it. But if I'm going to buy a dozen eggs at Costco or 5 dozen eggs, I might be able to get those eggs cheaper than buying them one at a time. That's the same theory in terms of using a mutual fund. It's pooling investors' money all together to create economies of scale and hopefully make the investing inside of that mutual fund cheaper for everybody. And it's also going to invest the monies that are put into the mutual fund based on a specific investment objective. And over time, there are so many different investment objectives that a mutual fund can have. They can be very broad, basically saying, hey, we're going to invest in any what we call large capitalization stock or any S&P stock or any Dow Jones stock, down to very narrow investment objectives, such as we're only going to invest in certain types of technology companies. And in every mutual fund, it's going to have what we call a fund prospectus, which is going to lay out all the specifics for that fund in terms of what it does, how it does it, who manages it, and everything else. And the objective for the investments will be outlined and stated in that fund prospectus. Now, a mutual fund can be both either active or passive, meaning you could have a manager that's managing the assets inside that mutual fund, and they could be very active. They could be picking different stocks, selling them the next day, moving around different asset classes, as long as they're staying within the objective stated in that fund prospectus. Or they could be passive. They could say, hey, we're just going to look at this index, the S&P 500, and we're going to try to mimic it. And we're pretty much going to make changes if the index makes changes, and if they don't, we pretty much aren't going to do anything. So you have a little bit of active side, or you could have a little bit of passive side. Or you have some funds which combine both strategies. And again, it's usually managed professionally by a portfolio manager. So some people find it is a great way to take a small amount of money, but have some very, very high-level professional expertise managing that money. Because if you pool it all together, like we said with economies of scale, now you have a portfolio manager who's managing maybe hundreds of millions or even billions of dollars, but you might only represent a tiny fraction of that. So it's a way that you can access a very professional money manager by not having a lot of money. And again, the performance of each fund is usually compared to a benchmark of similar investments, meaning that if they say, hey, we were able to make 9% this year, well, that's great, but how did you do against something that was generically similar? If that benchmark earned 10%, then maybe the manager underperformed, even though 9% is a good rate of return in a vacuum. If they did 12%, they might have beaten their benchmark. So even though the overall markets might have done 19, as long as they're beating their benchmark or they're close to their benchmark, that you know that that manager has been relatively successful in managing the assets inside of that mutual fund. How does a mutual fund charge for managing the assets inside the mutual fund? That's done through what we call an expense ratio. An expense ratio might be 0.5%, meaning that they're going to charge the assets of the fund 0.5% annually. They might do it every quarter, prorated out, but that's going to be the expense for the fund managers and that mutual fund company to their charge for managing those assets. So, and that expense ratio is going to be made up primarily of two parts: the management fee that's paid to the managers, as well as maybe some other administrative fees if those apply. And that equals your expense ratio, which is the expense for using that particular mutual fund. Then, and this normally only comes in outside of 401k plans, you might have different ways that mutual funds are sold or bought, meaning you might have front-end sales charges. So if you're working with an advisor, they might use what are called A shares, in which case if you put $1 into the fund, 5 cents is taken out as a sales charge in the beginning, and the remaining 95 cents is put into the fund for you. Sometimes there's what's called a back-end sales charge, where there's a charge that only occurs if you take the money out at the end of a year or 2 years or 3 years, and over time those might go away. But they're only charged, $1 that you have goes into the fund, but you're only charged a back-end charge if you take it out before a certain time period has elapsed. Then there's what are called no-load funds. There's no charges occurred where the monies are invested or withdrawn. And so a lot of times people use fee-only advisors. We are fee-only advisors that might utilize these, and then they charge an additional management fee for managing those funds as on top of any expense ratios that are inside the mutual funds. But they're considered no-load funds. There's no front-end sales charges. There's no back-end sales charges. There's simply you buy the fund, and depending on the advisor, there might be a percentage of fees of assets under management. And 401ks, inside of those accounts, you're mostly using what are called no-loaded funds. So you might have a charge that, like, let's say you're in a John Hancock 401k plan. There might be a small charge that John Hancock charges for managing the plan, but the only charge on that particular mutual fund might be the expense ratio. There's no front-end sales charges, and there's no back-end sales charges. So let's take a look at what an exchange-traded fund is. And these are relatively newer instruments that have been developed over the last 10, 15 years. And like a mutual fund, it's comprised of different assets or securities. And so you have instant diversification. It might be a fund that owns 20 stocks, 50 stocks, 100 stocks, or it could be a bond exchange-traded fund where it owns a variety of different bonds. But again, it's going to be comprised of multiple assets or securities, so you have instant diversification. Now, ETFs have evolved since their inception. And in the beginning, they usually just tracked a benchmark or an index or an industry. So a really popular example of an ETF is what's called the SPY, and that is an ETF that purely just tracks the S&P 500 index. So if you said, hey, I want to be able to buy that index and I want to do it through an ETF, I'm going to buy the SPY. Now ETFs are developed where you can get a little more specialized with them and you can do some different things strategy-wise, but for the most part, they're there to track an index or a specific industry or an idea. But unlike a mutual fund, it's a marketable security that's traded throughout the day and can experience price changes throughout the day. So it has a higher degree of liquidity. Again, but the price can fluctuate daily. With a mutual fund, it's valued at the end of each day based on the amount of shares of that fund that are outstanding and what we call at a net asset value. So at the end of each day, a mutual fund is valued. An ETF is valued throughout the day. So you can see the price of an ETF go up and go down all throughout the day. So it might be a little more liquid than a mutual fund, but it's certainly a difference in how it's traded and valued. And in most cases, not all, but in most cases, it's not managed by a portfolio manager. It has a company that oversees its structure and makes sure it's operating efficiently and properly, but it's computer managed in most cases. There might be a logarithm or specific computer instructions set up to help manage and operate that particular ETF. And typically, because there's not as many moving parts, you're going to find a lower fee cost structure associated with ETFs in terms of an expense ratio and how much they charge for that expense for each particular ETF. Again, you might find some mutual funds that are extremely cheap, but I'd say overall, generally, ETFs on the whole are probably cheaper to operate and fee-wise than a mutual fund. Now, ETFs can have trading fees, meaning if you try to buy or sell one during the day, you might incur a trading fee charge, $10.99 or $15.99 or $50 per trade. Some ETFs are no trade fee ETFs, where meaning there's no cost depending on the custodian, like Charles Schwab or TD Ameritrade, to buy or sell those. So if you said, is there a cost for me buying or selling an ETF? It depends. There might be, or it might be a no trade fee ETF. So let's look at a quick comparison and some similarities between mutual funds and ETFs. Obviously, both are reducing your risk by increasing diversification by holding a basket of either assets or securities or bonds or whatever that mutual fund or ETF is designed to hold. You have less risk because they're holding a variety of instruments underneath them. And they're built and constructed for you by professionals. So even though an ETF might be computer managed, it's structured by professionals. Just like mutual funds are, they're monitored, they're governed, there are rules that they have to abide by through the SEC and different organizations. So again, these are professionals that have built them for you, and you can take some comfort in the fact that they're being built properly and they're being regulated. So some of the differences, though, that we see between mutual funds and ETFs, there are a variety. So as I said before, mutual funds are valued at what's called net asset value at the end of the day. So during the day, you might not know what your mutual fund share is worth until the close of business that day. Then they can value all the assets inside it. They take the amount of shares that are outstanding, and they come up with what's called a net asset value per share. ETFs are valued throughout the day based on intraday trading. So again, different valuation structures for a share of a mutual fund than there is for one share of an ETF. Also, in terms of strategy, mutual funds can be active or passive. ETFs are mostly passive in nature. So again, depending on your philosophy or the type of portfolio that you're trying to build, you might just use mutual funds, you might just use ETFs, or you might use a combination. But again, different strategies for each one of those. If we're talking, and some of the differences also revolve around tax advantages or disadvantages. And again, this is only going to apply outside of 401k or other qualified plan accounts. So mutual funds can have tax disadvantages because at the end of the year, they might issue what are called capital gains distributions, both either short-term capital gains distributions or long-term capital gains distributions. So you might not want to take a distribution from a mutual fund, but you might not have a choice if it's outside of a qualified plan account or an IRA account. ETFs have some tax advantages, meaning that they're usually not going to have capital gains distributions. Now, in both cases, if mutual fund has dividends, they can issue those. If an ETF has dividends, they can issue those. But for capital gains, outside of qualified plans or IRAs, ETFs probably have a tax advantage that mutual funds do not enjoy. But in terms of what we call auto investment options, meaning I'm going to take some of those distributions and I'm going to turn right around and buy new shares of my mutual funds. I don't want those distributions in cash. Mutual funds have an advantage. They have an auto investment option that you can automatically reinvest all capital gains distributions and all dividends. ETFs, you do not really have an auto investment option whatsoever. Now, inside a 401k plan, you automatically take any money that's going to, and they will go circuitously back into those funds. But for the most part, outside of plans like that, again, ETFs do not really have an auto investment option. So if you're looking at trying to reinvest your dividends or capital gains, you might take that into consideration when you're deciding between an ETF and a mutual fund. So let's look at some cost differences as well, because that's important. So again, we talk about expense ratio, which is the one charge that mutual funds and ETFs have inside of them that is the payment to the people who are managing and structuring those particular funds or ETFs. So again, ETFs are on the whole, on average, cheaper than mutual funds. Mutual funds can range from pretty low, if you're just mimicking an index, to quite high if they're looking at managing international emerging market bonds, or they have a very sophisticated strategy that they're trying to employ. Whereas ETFs are mostly going to be anywhere from 0.05% to maybe up to 1%. But on the whole, if you're saying, hey, I just want to go the cheapest way possible, ETFs are probably on the whole cheaper. Trading costs, again, ETFs could have a charge for trading per trade, or you could have no trade fee ETFs depending on your custodian. Mutual funds might have a front-end sales charge or a back-end sales charge, or you might have no loaded funds. So again, different ways to pay for those in terms of how you're going to buy and sell them. And for minimum purchase amounts, ETF's minimum purchase is simply the share price of one share, or maybe you can even buy a fractional share. Whereas with a mutual fund, they might have a minimum purchase amount. For example, you might have to start with $250, and then every time you want to put in new money, you might have to put in $50 at a minimum. Some have zeros. 401k plans, there's really no minimums whatsoever. You can simply say, hey, I'm going to take the $50 out of my paycheck, and I'm going to buy 2 or 3 different mutual funds if I want to. So again, sometimes you're going to find some minimum purchase amounts that are different between mutual funds and ETFs. So when would we utilize these? So I'm going to give you some generic rules of thumb. However, when to utilize them depends on the types of accounts that you're looking at, you as an investor, and your other investments that you may or may not already have in place. So your financial planning that you've already done, or other investments that you've put into place. So I always tell people, we're going to give you some rules of thumb here. But if you're really interested on when you should utilize these, feel free to call our office, talk to Chris, or talk to another member of our staff. We can certainly help you, because many times when you utilize one or the other or both is very specific to your own facts and circumstances. But in general, you're going to use an ETF if you primarily believe in passive investing, if you believe in what we call buy and hold, which means I'm just going to buy it. I'm not planning on making many changes either in this year or in subsequent years. I'm just going to kind of buy it and sit on it and forget about it. Or if you're outside of a 401k account, you might be trying to time the market, meaning I'm going to buy the market today through a SPY ETF, and then I'm going to sell it in 2 weeks because I think the market's going to go down. Again, you can't time the markets inside of 401k plans, but outside of 401k plans, people will use ETFs to try to time the market. Or you want the lowest possible cost, the absolute lowest possible cost, or lowest cost in theory overall in terms of these types of investment vehicles. Mutual funds, when you would utilize them, is they're a great way to use a small amount of capital to access a professional money manager for maybe that specific investment objective that you would not be able to do on your own. A lot of these money managers, if they're really good, you might need $1 million or more as a singular investor to be able to get them to manage your money. If you use a mutual fund that they manage, you can do it with much smaller amounts, maybe as little as $250, $500, or $1,000. If you believe in active, or what we call tactical investing, mutual funds are probably the better place, because they are the investment vehicle that lets money managers be active and tactical in nature, whether it's moving from one asset class to another or selling and buying stocks rapidly inside an asset class. There are mutual funds that do passive investing, just like ETFs would, but primarily if you're looking at mutual funds, you probably are leaning more towards the active management style. But again, you might find some that are mimicking indexes at a very low cost as well. And again, if you're trying to seek a very specific investment objective, you might be considering mutual funds, although ETFs are getting better and better in terms of developing very specific investment objectives that are go all over, everywhere from investing in gold, oil and gas, to just very general stocks and bonds. So ETFs are starting to level the playing field, but again, if you're seeking a very specific strategy or investment objective, you might be looking at mutual funds. And if you're planning on reinvesting dividends and interest and capital gains through auto investment options, you definitely want to look at mutual funds. So that gives you an idea of, some of the differences between them, some of the similarities between them, how they're structured, how they operate, and when you might possibly want to utilize them. So we're about at 12:30 here, so I don't want to go over. So if you have individual questions, if you're not sure which is right for you, or you have questions outside of this topic that you'd love help with, whether it's on your 401k or something else, please feel free to give us a call, 480-494-2750, or shoot us an email. Your HR department will have our contact information. We're here to help. So again, I appreciate everyone's time and hope to be talking to you soon. Thanks and take care.